There's a financial instrument sitting in plain sight in every insurance office in America that allows you to become your own bank. You deposit money into it, it grows tax-free, you borrow from it whenever you want, for any reason, without a credit check, without a bank approval, and without ever paying income tax on the money you take out. The interest you pay on the loan goes back to you, not to a bank, not to a lender, to yourself. And when you die, the entire remaining balance passes to your family completely income tax-free, often multiplied 2 to 5 times beyond what you ever put in. The cost to open one is as low as a few $100s. The financial industry spends approximately $80 billion a year in advertising to make sure you never learn how it works. It is called a whole life insurance policy, and the strategy built around it has a name that the banking industry wishes you had never heard: infinite banking. In 1913, the same year the Federal Reserve was created and the modern income tax was ratified through the 16th Amendment, this instrument was already a century old, and the people who wrote the tax code knew exactly what it could do. They did not ban it. They could not. Too many senators, too many industrialists, too many old money families already depended on it. So they did something more effective. They buried it under complexity, jargon, and an entire financial advisory industry trained to steer you toward products that generate commissions for someone else. They did not stop using it because it failed. They stopped teaching it because it worked too well. Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. Let me take you back to the beginning. Life insurance is older than the United States itself. The first recorded life insurance policy in America was written in 1759 in Philadelphia by a company called the Presbyterian Ministers Fund, now known as Covenant Life Insurance. But the concept stretches back to ancient Rome, where burial clubs called collegia collected monthly dues from members and paid a stipulated sum to the families of the deceased. By the Middle Ages, guilds in England and continental Europe had formalized the practice. Merchants in 14th century Genoa and Florence used early forms of life contracts to hedge against the death of business partners during long trade voyages. The modern mutual life insurance company emerged in the 1840s. New York Life was founded in 1845. Massachusetts Mutual in 1851, Northwestern Mutual in 1857. These were not corporations in the Wall Street sense. They were mutual companies, owned by their policyholders. Every dollar of profit was returned to the owners in the form of dividends. And here is the critical detail that most people miss. Those dividends were not classified as investment income. Under IRS rules that persist to this day, dividends paid on a participating whole life policy are considered a return of premium. They are not taxable. You read that correctly. The money grows and the growth is not taxed. The mechanics work like this. You purchase a participating whole life insurance policy from a mutual insurance company. Unlike term insurance, which expires after a set period, whole life is permanent. It covers you for your entire life. Part of your premium goes toward the cost of insurance, the death benefit, but a significant portion goes into what is called the cash value, a savings component that grows at a guaranteed rate plus non-guaranteed dividends. The cash value is yours. It accumulates inside the policy tax-deferred, meaning you pay no taxes on the growth as long as it stays within the policy. Now here is where it becomes extraordinary. Under Section 7702 of the Internal Revenue Code, as long as the policy meets certain premium and benefit tests, the cash value can be accessed through policy loans. These loans are not taxable events. You are not withdrawing money from an investment. You're borrowing from the insurance company, and the company uses your cash value as collateral. The money in your policy continues to grow as if you had never touched it. You receive the loan proceeds tax-free, and the interest you pay on the loan is paid back into the policy or to the insurance company's general fund, depending on the structure. But in participating policies, the net effect is that a substantial portion of that interest eventually returns to you through dividends. This is not a theory. This is how the Walt Disney Company funded the construction of Disneyland. Walt Disney borrowed against his life insurance policies when no bank would give him the money. Ray Kroc, the man who built McDonald's into a global empire, used cash value life insurance as a personal financing tool. J.C. Penney, Doris Christopher, and dozens of other American entrepreneurs did the same. According to the American Council of Life Insurers, as of 2023, the life insurance industry held over $4.4 trillion in total assets. Whole life policies represent a significant share of that figure. Banks themselves are among the largest purchasers of permanent life insurance through a practice called bank-owned life insurance, or BOLI. The FDIC reports that as of 2023, American banks held over $203 billion in BOLI assets. They're literally using the same instrument to grow their own reserves that their financial advisors tell you not to buy. Read that again. The banks tell you whole life insurance is a bad investment. Then they buy hundreds of billions of dollars of it for themselves. Before I go further, this video is just the surface. Inside the Invisible Ledger vault, you will find the complete breakdown of how to structure an infinite banking policy, the exact questions to ask an insurance agent, dividend comparison charts across major mutual companies, loan structuring guides, and the exposed history of how the financial industry campaigns against whole life to protect their own fee income. The link is in the description, but stay right here. The man who formalized the infinite banking concept was R. Nelson Nash, an Alabama forester turned financial educator. In 2000, he published a book called Becoming Your Own Banker, which laid out the entire system. Nash did not invent the mechanics. He simply organized and named what wealthy families and corporations had been doing for over a century. His core argument was devastatingly simple. Every financial transaction in your life involves a banking function. When you buy a car, you either pay cash, which means you lose the opportunity cost of that money growing somewhere, or you finance it through a bank, which means you pay interest to someone else. Nash proposed a third option. Finance it through your own whole life policy. Borrow from your cash value to buy the car. Then pay yourself back with interest. The interest you pay goes back into your policy, increasing your cash value and future dividends. You have now captured the banking function. You are the bank. The financial advisory industry responded with hostility. The reason is mathematical and structural. A financial advisor who manages your money in a brokerage account earns a fee, typically 1% of assets under management per year, on a $500,000 portfolio. That is $5,000 a year in perpetuity. If that same $500,000 goes into a whole life policy, the advisor earns nothing. The insurance agent earns a commission in the first year, but after that, the ongoing revenue disappears. The mutual insurance company manages the money internally. There is no annual management fee flowing to Wall Street. This is why every mainstream financial publication, every robo-advisor, every fee-based planner has a ready-made script about why whole life insurance is a terrible product. It is not terrible for you, it is terrible for their revenue model. If you have made it this far, you already know more about the banking function of life insurance than 99% of Americans who will work their entire lives paying interest to institutions instead of to themselves. Subscribe and share this video. The tax advantages are codified in multiple sections of the Internal Revenue Code. Section 101, Rest A, establishes that death benefit proceeds are received income tax free by beneficiaries. Section 7702 defines the limits within which a policy qualifies for tax-favored treatment. Section 72E governs tax-free withdrawals up to the cost basis. And policy loans, as established by decades of IRS rulings and court cases, are not taxable distributions as long as the policy remains in force. The combination of these provisions creates a financial vehicle that grows tax-deferred, can be accessed tax-free through loans, and transfers to heirs income tax-free at death. No 401k, no IRA, no brokerage account, no savings account, and no real estate investment offers all three of these tax benefits simultaneously. Now, let me tell you what you can actually do with this information. Step 1. Find a mutual insurance company, not a stock company. Mutual companies are owned by policyholders and pay dividends. The major ones include Mass Mutual, Northwestern Mutual, New York Life, Guardian Life, and Penn Mutual. Step 2. Request a participating whole life policy designed for maximum cash value accumulation. Tell the agent you want the policy structured with a paid-up additions rider, which allows you to overfund the policy within IRS limits and accelerate cash value growth. Step 3. Fund the policy consistently. In the early years, the cash value grows slowly because commissions and insurance costs are front-loaded. By year 5 to 7, the cash value typically exceeds total premiums paid and begins compounding. Step 4. Once sufficient cash value has accumulated, borrow against the policy for major purchases, investments, or emergencies. Pay the loans back on your own schedule with interest. The interest effectively recycles back into your financial system. Step 5. At death, the remaining death benefit passes to your beneficiaries income tax-free under Section 101A, often 2 to 10 times the total premiums you paid over your lifetime. The total cost of entry depends on your age and health. A healthy 35-year-old can start a policy designed for infinite banking, with annual premiums between $5,000 and $25,000. The long-term internal rate of return on cash value, including dividends, typically ranges between 3 and 5% tax-free. Compare that to a savings account paying less than 1% or a bond fund paying 3% but fully taxable. I need to be honest with you, this is not a get-rich-quick scheme, and there are real limitations. First, whole life insurance has high first-year costs. Commissions and insurance charges mean your cash value in year 1 may be significantly less than your premium. This is a long-term strategy, not a short-term savings vehicle. Second, if you surrender the policy early, you may receive less than you paid. Whole life is designed to be held for decades, ideally for life. Third, the guaranteed returns are modest by stock market standards. If you are comparing pure growth rates, an index fund has historically outperformed whole life. The advantage of whole life is not raw growth. It is tax efficiency, access, guarantees, and the death benefit multiplier. Fourth, not all policies are structured correctly. Many agents sell whole life policies designed to maximize the death benefit, not the cash value. If you do not specifically request a policy designed for banking, you will get the wrong product. Fifth, policy loans do accrue interest. If loans are not managed properly, they can erode the death benefit or cause the policy to lapse, which can trigger a taxable event. Your great-grandparents understood something that the era of credit cards and auto loans made you forget. Every dollar you spend has a cost beyond its face value. It is the cost of the interest you pay to someone else or the growth you lose by spending it. For 200 years, families who understood the banking function kept their wealth inside instruments they controlled. Then one generation was taught that insurance was only for death, that banks were the only source of loans, and that Wall Street was the only path to growth. There was not a better system. There was just a more profitable system for the institutions that replaced you as your own banker. Subscribe and share this video. Every share restores a piece of the financial architecture they spent a century dismantling. The next vault opens soon, and what is inside will show you a forgotten law from the 1800s that actually pays you to pay off your own mortgage. Got it.